Hi, everyone, and welcome back to Frank Wealth Insights. I'm Frank Fantozzi, President and founder of Return on Life Wealth Partners. Today, we're talking about exit planning, but not at the surface level. Many business-owning families understand the basics. Someday, they may want to sell, transition, or step away. What's often missed are the legal, financial, and risk-related details that quietly shape outcomes long before a transaction ever appears on the horizon. Advanced exit planning isn't about rushing to a sale. It's about preparing intentionally so that when opportunities or life changes arise, families are positioned with clarity, flexibility, and fewer surprises. To help us explore this, I'm joined by Alex Gertsburg, an attorney and CEO of CoverMySix. Alex works closely with business owners on legal strategy, risk management, and continuity planning. And he's seen firsthand where exits succeed and where they break down. So before we get started, a quick reminder, this podcast is for general, informational, and educational purposes only and does not constitute financial, legal, or tax advice. Always consult your qualified professionals before making any decisions. And Alex, thanks again for joining us. I'm looking forward to digging into beyond the basics, what it really means for business owners to look at exit planning and continuity planning. So my first question for you, on the surface, what are the most common misconceptions that keeps owners from real readiness?
I guess the biggest one is I'll be fine when I get there,
So
right?
what does that mean?
So hey, I've got my retirement account. It's pretty well stocked. I've got investments over here. My business is cash flowing. Um, I'm fine. I'm fine. I don't need a whole lot of planning. That's the biggest misconception,
Okay.
Frank. Half of the businesses in Cleveland are owned by people approaching retirement, believe it or
Wow.
not, well over 55 years old. Time and time again, I'm working with people who are 64 years old and have done zero by way of exit planning other than planning to exit plan,
Yeah,
right?
they planted the
And
seed.
yeah, exactly. So that's the biggest misconception. If you're planning it in the 12 months before, if that's when you're putting your succession plan together, if that's when you start talking to exit planners, to your wealth manager, to your estate planning attorney, um, I mean, it's better than doing it the day
Yeah.
before. 3 to 5 years out is what I tell
Okay.
people, right? It takes a lot of um, nuance and curating and team building. And the earlier you start, the better, the
Yeah.
better.
Oh, I totally agree. So what do you think gets in the way besides the fact that they think they have time? Is it a fear of letting go? Is it a fear of, I got to really work on my business? I still got to make money. What do you think gets in the way? Because what you're saying makes a lot of common
It,
sense, but sometimes common sense doesn't translate into action.
I'll answer it by kind of reversing the question a
Sure.
little bit by what forces people to think about it.
Hmm.
Right? And it's the failure to imagine those things, right, that tends to, get in the way, in my opinion. So what tends to force people to start thinking about
Hmm.
it is an event, health event, um, something in the economy
Right.
happens, their business, tanks, they lose a big account, they lose, a key
Right.
employee, and now they're panicking, right?
Hmm.
So, in my opinion, it is the failure to anticipate those things that gets in the way. And we're human beings,
Right.
right? So we have the same cognitive biases that we've had for 100,000 years, right? We have confirmation bias is the big one. I'm fine. I'll figure it out.
Right.
That's the belief. That's the belief. Confirmation bias. You prioritize the evidence supporting that
Mm.
belief and deprioritize the evidence that negates that belief. The belief is I'll be fine. I'll get to it when I get to it. So what do you see? You see a stock portfolio that seems happy. You see cash flow in your business that seems
Right.
happy.
So
Um,
nothing's wrong.
and so you just, yeah,
Mhm.
exactly. So you don't think, wait a second. wait a second, something might happen. I might need to get a written succession plan in place right now. I might need to designate a trustee to manage my business if something happens. And oh, by the way, this might take longer than a few months to plan correctly. Nobody thinks that. That's what
Yeah,
gets in the
I think
way.
it's a lot it's similar to when we work together with clients that do personal estate planning. They feel
Yeah.
like they're inviting the inevitable, and instead of trying to be proactive. So outside of the 5 Ds, and if you want to comment on the 5 Ds that normally are pretty critical, those are like event driven that you were talking about. What are they potentially leaving on the table when
Yeah.
they decide, hey, I got time. And then, a year out, even two
Yeah.
years out, they're saying, okay, I want to get my business ready for sale. But then their business is not really in a saleable form. Even though they're making money and everything seems okay, they have what I call baby bias. My baby's beautiful, but everyone else
Mhm.
thinks the baby is ugly. So you're sitting there going, trying to
Yeah.
sell something that no one wants.
Yeah. Such a good question. Um, things that I see most often are number one, um, you've spent 30, 40, 50 years building this asset that is your
Hmm.
business, building these relationships, and the intellectual property in your business, all of the things that put money in your pocket and that create transferable wealth, transferable value. And so among the things that I love that you just said leaving on the table is you have been optimizing for cash flow. You have been optimizing for potentially a sale one day down the road.
Right.
If you haven't met with a Frank Fantozzi, if you haven't met with someone who can look at your books and records and value your intellectual property, your key valuation drivers until the year before you're going to retire, then you actually have not optimized for transferable value. Here's an example. Business is going well. You've got good cash flow. You've got good EBITDA, but your cap table is a mess, and your corporate governance processes are all over the place, and you've got a lawsuit just breathing down your neck that you should probably put your emotions aside on and settle so it's not blowing up on you in the next year or two. And you've got these other diligence issues that need to be resolved and that don't happen overnight. You've got IP gaps. You're potentially not protecting the, um, you know, trademarks, patents that should be formalized,
Right.
at the U.S. Patent and Trademark Office. And meanwhile, there's a potential that you're infringing on someone else's intellectual property. Those are the
Right.
gaps, right? Those are the things that you're not thinking about when all you're thinking about is EBITDA and cash
Right. Yeah. So
flow,
you're living in the
right?
moment, and so I look at it, and I'm gonna leads me into what you were talking about. So companies look at getting a valuation. I find that they're looking for the number, and what I try to talk to our clients about
Yeah.
is your valuation is a number. That's the culmination of all these things that lead to the number. But a valuation is a peer-to-peer comparison to other businesses to benchmark. And if you wonder why your business or my business doesn't sell for what you think it should sell, it's usually there's something that's not working at an optimal level within the business, whether it's your SOPs, you mentioned corporate governance. Oh, wait a minute, the business really revolves around the owner, and when the owner is gone, what's there to transfer? So can you talk about more? You were going down that path. I wanted you to elaborate a little bit about some of the key things. If you're a buyer, and I think that's always the best way to look at it, what is a buyer
Yeah.
looking for when they're buying your business?
Quality of earnings is the number one, right?
Mm-hmm.
Um, how reliable are the financials? How reliable is the revenue? Um, is there any, you know, accounting irregularities? Um, I'm buying a business because I'm parting with a boatload of money up
Mm-hmm.
front and committing myself over
Right.
time to keep parting money. right? Much less the time, the aggravation, the investment, the non-financial investments that you are committing to when you buy a business. So number one is, how reliable is this revenue? Is it all consolidated with like two customers?
Yeah,
Is
right.
it
That's a big
is it
risk.
yeah, is it or is it diverse? Because diversification of revenue drives valuation up, consolidation of revenue drives valuation down. And all the things that I just mentioned, same thing, right? It will, if you don't have your the quality of your revenue and your earnings airtight
Right.
and enough to give the buyer confidence, that's the first thing that's going to make them walk,
Okay.
or give you an offer that is insulting to
So
you.
that leads me to think about, if I'm a buyer, I want to be able to just step in and have the systems, chug along. I want everything repeatable. So what are some of the repeatable things from an operations standpoint, an employee
Yeah.
standpoint, that you look for when you're advising clients to either sell or buy? Because it's the same thing. It depends what
Yep.
optic you're looking at, if you're the buyer or the seller.
Yeah. I think of it this way, Frank. I think of it as humans plus processes plus
Okay.
documentation equals reliable, predictable confidence post closing. That's what the buyer's looking
Okay.
for. So humans, right? Does the business depend on this owner, and on some number of clients and on a small number of employees? What does the leadership team look like? How locked in are they are post closing?
Right.
Can I lock them in? How happy are they? What does churn look like? Right. So that's
Okay.
humans. Next is processes. How much of how evolved, developed, um, efficient, productive, are the and predictive
Right.
are the processes. And third is documentation. Those processes are either in someone's head, which means that they're not very transferable, or they're written in a readable, understandable, logical, and transferable way.
Okay.
Okay, so from my perspective, those are three absolutely critical components to give a buyer confidence in that
All
area.
right. So if I'm the buyer, and I always try to tell our clients, you have to anticipate what the buyer's going to look for, because they're going to look under the hood and they're going to see everything good and bad about your business. So where do you think diligence starts as a buyer so that a seller then can prepare? I always do the analogy of, like, I want to get my house for sale. Most real estate agents come in and tell you,
Yep.
okay, if you want X, we need to kind of clean up, paint everything neutral, new carpeting. Yes, it's going to cost you X, but you'll sell it for Y, and you get an ROI in that small investment in preparing your business to be sellable. So what do you think, where do buyers start, and where do owners, I think, get tripped up because they don't think and put themselves in the
Yeah.
buyer's shoes?
Yeah. Well, they're going to start with the
Okay.
numbers, right? That you don't pass go and get into everything else, the people, the processes, the litigation. You don't get there unless you've got good numbers. What are they, right?
Right.
So their revenue, their margins, their cash flow, and then its growth potential. Um, Generally, especially if it's a financial buy. So you got financial buyers, you got
Yeah.
strategic
So why don't you
buyers,
define
right?
the
So
two
Frank,
that for our listeners?
yeah, yeah. Financial buyers are buyers who are primarily interested in what they're going to take out of the business
Hmm.
financially every month, quarter, year. These tend to be your private equity buyers, um, investment type of buyers. Okay. That's their
Okay.
priority. And quite often they're looking to get in and out in a relatively short period of time. There are some who are buy and hold kind of buyers, but think PE,
Yeah.
right? They're looking for numbers over almost everything
Okay.
else. And then you've got strategic buyers, and those are competitors,
Mm,
potentially. Those are people in your industry. Those are people who want to bolt your company onto their company because it will be
mhm.
additive to what they're already
One plus one
doing.
equals three.
They have exactly, exactly. They want your capability, they want your reach, they want your assets because of what they bring to an existing
Okay.
strategy or idea or business. So and this is important because those guys prioritize things differently. Obviously, the financial buyers are looking almost exclusively about at revenue, earnings, and growth potential,
Okay. Yeah,
right?
I agree.
The strategic buyers, those things are important. Those are important, but they live right alongside of a broader strategy. What can this do for what I've got going on already and what I want to happen moving forward? Um, so your question was, where do buyers start? What do they look for? That's, in my view, kind of what they prioritize based on who they are. Once they get comfortable with the
Okay.
numbers and projections, the next thing they look for is um, the elements that create confidence and predictability in the future deal. So that's where they think about leadership teams and who's staying, who's going, the processes, um, and then they tend to start with the positive things and then go to the negative things, right? So the positive things are growth
Right.
related and revenue related. The negative things are the minefields, the skeletons in the
Right.
closet. Okay. So that's when they start, and it's usually in the context of due diligence, right? Which we can talk about the phases of mergers and acquisitions deals. I'm a lawyer
Mhm.
first, Frank, and then an exit planning and a strategist, I guess, later in my
Right.
career. Um, but basically during diligence, which usually happens after the LOI is signed, the letter of intent or term sheet. That's where the business terms
Mhm.
go. Um, After the LOI or term sheet is signed and the general business terms are negotiated, now you're going into diligence and the drafting of your definitive purchase agreement and your representations and warranties that are part of that, right? So reps and warranties track due diligence. As you learn things in diligence, that then translates into a representation that something is or is not true about your
Okay.
business and a warranty that it will continue to be true or not true. And then that turns into an indemnification. I will indemnify you, buyer, if something I said in reps and warranties is inaccurate. So the due diligence on is intended to, well, number one, validate your assumptions, but number two, uncover those
Right.
negatives. Where have there been, is there a sexual harassment claim? Is there
Right.
grievances that employees consistently have? Are there labor issues? Are there lawsuits looming? Has a key customer been complaining about their contract? Are the contracts assignable in the first
Right. Yeah,
place?
that's important.
Um, so all of those things kind of like waterfall down from, you know, big ticket items, um, primarily starting with numbers down to, what are they not telling
Right.
me about exposure?
Ah, that's good. Great advice. So you mentioned governance earlier. Can you elaborate more on the
Yeah.
decision-making structure, how that affects valuation? And without trying to create a bureaucracy, what are some simple governance improvements that can help a business be more salable?
So many small businesses and mid-sized businesses operate on handshakes among owners. Okay. So just a little let me take one step back and explain it this way to your listeners, Frank. So the United States government and the state of Ohio or whatever state your listener is in has a drug deal with entrepreneurs. And the drug deal is, hey, you guys are the engines of capitalism. We want you to take risks. We want you to have employees who will pay taxes. We want you to pay taxes. We want you to create things and build things and make our cities grow. And so, in order to help you do that, and to encourage you to take risks, we are going to protect your personal assets if something goes
Okay.
south. You don't have to worry about that anyone taking your house, your car, your kids' college savings. All you have to do is follow a few simple rules, one of which is follow corporate
Mhm.
formalities. That's where the governance issues come
Okay.
in. Okay. What does that mean? So, um, do you have, are you the first, which is almost certainly true for all of your entrepreneur listeners, is the first biggest corporate formality is you have an entity. You are not a sole
Right.
proprietor. You actually formed and then formed your company and filed articles of registration or articles of organization with the Secretary of State so that the whole world knows that, you know, return on wealth or return on life is not Frank Fantozzi.
Correct.
Frank and his firm are two different
Two
things.
different entities.
Okay. Two different, right, exactly. The word corporation, the root word is corpus, which is Latin for
Right.
body. The idea is your entity, your corporation is a separate body. It's a body separate from Frank Fantozzi. Okay. So to demonstrate that, you have to file with the Secretary of State. That's the first corporate formality. The second is you need to not commingle Frank Fantozzi's
Those Italian
personal,
names are
uh,
tough.
I know, personal expenses with the business's expenses. You can't, you know, most business owners do run some amount of, travel and entertainment and restaurants and cars and whatever through their business, but which is fine. Just make sure it's well
Yeah.
documented. Okay. Make sure that there are good books and records. And so you have to avoid commingling. And then the other is, this is my I'm putting my corporate lawyer hat on. Every business needs to not just file with the Secretary of State, they need an operating agreement if it's an LLC, or a shareholder agreement if it's a corporation, or a partnership agreement if it's a partnership. And there's other names for the documents, but you really need to have one of those.
Okay.
You can't just file with the Secretary of
And
State.
just wash your hands. I'm all
Um,
done.
yeah, exactly. So following corporate formalities means having one of those documents in place and then complying with the requirements in those documents. So, for example, if your corporate shareholder agreement says you need to have a board of directors, you better have a board of
Right.
directors. Um, which means that then you have to have bylaws, which means you probably need to have meetings of your board of directors
Minutes
and
of.
minutes of those meetings, and whatever decisions need to go through the board do go through the board. You're having shareholder meetings, same thing, minutes, decisions. So all of those corporate formalities go into and arguably define the question of corporate governance, which is your
Okay.
question. So those need to be followed, and there's a lot of data out there too. The tighter and more compliant the corporate formalities, A, the more likely the deal goes through, and B, the higher the valuation. And that may be correlative or it may be causal. I don't know, but
But it
it
works.
does reflect, well, it reflects how serious the owner
Hmm.
is, and, it also reflects, a level of confidence in the buyer,
Okay.
you know? I'm buying a company that is a serious company and that doesn't have a lot of, you know, backdoor, handshaking kind of deals that I should have,
Yeah.
skepticism
You don't
about.
want any loose ends.
And also, I mean, I should say too, right, a good cap table, is important. If you've got multiple owners and you want to make sure that everyone's interests are well documented, that they're aside from the partnership and operating and shareholder agreement, if there are other compensation agreements or decision making documents, they should be clear, and readable and
Okay.
enforced. Oh, well, and I guess the last thing I'll say too is the more consolidated decision making is with one human, um, the less confidence um, the buyer has relative to if there is a committee or a board or shareholder decisions that rise to that level and that are met through some sort of deliberative body. A leadership team is great,
Yeah.
right?
Well,
So
I would add to it,
yeah,
it's an
so if you
empowered leadership team. They can make decisions
right,
without the owner having to sign off on it.
that's right, that's right. But good diversification of thought and decision making is a valuation lever that goes north, not
Okay,
south.
great. So we're going to pivot a little bit. Why is it risky to treat business planning, tax planning, and estate planning as separate
Mm,
conversations when you have a business which probably represents the largest asset on a business owner and entrepreneur's net worth statement?
yeah, great question. So, number one, if you treat those in silos, then you're going to get siloed decisions and advice. Man, so your I would put it like this. Your team of advisors should be talking with each other as they build your strategy. And those advisors should include an estate planner, a financial advisor, a tax advisor, and an insurance advisor at
Okay.
minimum. And then the exit planning person who is there to kind of like, steer everyone towards the exit and post-retirement goals that you've got. So, um, if you are talking with these folks individually, and they're not coordinating with each other, then you're going to get incomplete advice and an inferior strategy relative to if they're
Yeah.
coordinating with each other. I mean, at a very high level, that's the most
Yeah.
obvious
And I think
answer.
also, I think people assume the more you add, it's actually more costly. But I would say if everyone's coordinated, everyone's going to have to just
Yeah,
focus on what they need to do as part of the team. They're not going to usually duplicate each other's work. And to your point, you're not going to have, what is the old saying, crack at the top is a cavern at the bottom. You try to want to avoid, things falling through the
right.
cracks because one side assumes the other side has it.
Yeah. Did I include in that team the business lawyer?
No, you didn't. But if you
Because
want to,
they
good
need to
plug
be
for
in that
you.
team. And I'm not saying that because I am one. I'm saying that because you're building a road between today and the exit day. And that should be a long road to travel.
Hmm.
Okay. The shorter the road, the shorter the timeline. The less you're going to get, and B, the more speculative your result.
Okay.
Okay, so so your business lawyer should be involved to help you uh, eliminate those minefields ahead of time, flag them,
Okay.
prioritize them, and make sure that what the buyer is going to see is what they're going to get,
Sure.
and it is a great, beautiful picture as opposed to a company that has exposure wherever the buyer's
Okay,
looking.
cool. No, I agree. And I would say like a 3D picture because I think there's depth of all of
Yeah.
this. You don't want to just see what's on the front. You need to be able to see what's behind. So what are some of the mistakes,
Right.
when people get into the process, right? They have potential buyers or thinking about getting an LOI. you've done all this work, and I've seen things kind of blow up in, kind of like in football terms, you're in the red zone, and you can't get it over the finish line. What are some things that happen or to be aware of when owners start getting, they're got their business ready, they're selling it, they're doing an LOI? What are some things that kind of trip things up in the, ninth and 10th hour?
The number one tripwire, I would say, that I see most often, and that I've seen both as an M&A lawyer and as a broker and advisor to folks who are
Mm.
exiting, is emotions. Emotions are, yeah, again, we're
Right.
humans. We are emotional people. We tell stories in our heads. Those stories are driven by, when you're 65, it's 65 years worth of assumptions and events and experiences and relationships, but they're all
Right.
stories. There's a lot of stories that drive our behavior and our emotions. And so the emotion is often one of uh, my business is worth X. Why? Because I've always assumed that it's worth X, and I've been driving towards that X, and now I'm
Right.
here. My biz and if you don't have a good valuation, objective, unemotional, logical, surgical valuation done by a
Right.
professional, then your assumptions about the value of your business are probably wrong. And that will really interfere with your ability to be objective when the time comes to negotiate your deal. That's the number one uh,
Okay.
obstacle. Okay. From there, it's, the things that people just generally overlook, the things that tend to blow up are like just sloppy handling of contracts and
Mhm.
customers,
Okay.
right? How well documented are the arrangements that I have with the people that are key and companies that are key to my business. Um, there's something called a change of control clause.
Okay. Go into
Okay.
that.
And this, I'm just throwing this out as an example, but it blows up deals. Okay. So in a lot of contracts, um, a one party will have a provision that says this contract is between you and me. And if you change control, if you sell your company, if you take on majority owners, I want to do business with you. That will, if you do that without getting my
Right.
consent, this contract is void, or this contract will not be assigned
Oh, wow.
to that. So it's which are two different provisions, right? One is non-assignment, one is change of control, but they play in the same spirit. And those are very common. And the bigger the company, the more savvy their lawyers when they wrote that customer
Right.
contract or vendor contract, the more likely that's in
Wow.
there. And so you don't think about it. Those blow up. And so now you've got a buyer who's going to offer you a boatload of money because you've got these key customer contracts or key vendor relationships. And then you get to that point where you have to where you start looking at these contracts and you're like, uh-oh, wait a
Yeah.
second. Is this guy going to consent to this? And then you find out that they're not going to consent to it, or that they want some pound of flesh for that
Right.
consent.
So they can hold you hostage. So these are
You're
like check the box things before you even get into the LOI. You talk to your biggest
Yeah.
clients and say, "Hey, we're planning on this. Are you going to be comfortable if you have one of these clauses in an agreement with them going with the company we select?"
So yes, but it's even before
Okay.
that. Before you're even talking to anybody, what you're doing is you're auditing your
Okay.
contracts, okay? And you're making sure that the most important ones either don't have that language in it or have language that is favorable to you. Um, or if neither A nor B, now you're talking to that client and making sure that you guys are best friends,
Yeah.
right?
A lot of power
That you guys
lunches.
are. That's right. That's right. But that's like a really common
Yeah.
tripwire, right? And then the other ones, Frank, I mean, just disputes, litigation, environmental issues, regulatory issues, those are things that will, if not blow up a deal, or if not drive down a valuation, what they end up doing is complicating a
Right.
deal, such that the buyer's going to say, you know what, I need to escrow $5 million. Right? I'm not giving this money to you. It's going to sit there until these issues are resolved because this is the value I'm putting on my exposure
Right.
to these
Okay.
issues. Right? Things like that.
So the things I've been hearing, and I'm going to restate it a little differently because I've shared this with our business owner clients, is to look at exit planning and succession planning as a business strategy. And to do so, there are things that you have to kind of repeatedly do, like get evaluation every few years, check your processes, check your organizational
Mhm.
structure. But this requires time and usually an investment, in evaluation experts, spending time with their legal, their CPA, their financial advisor.
Yeah.
How do you convince, or not say convince, make them see the light that, hey, you're going to have to spend money every few years reevaluating your business so that you can optimize your enterprise value and get an ROI. How do
Yeah.
you get them to buy into spending money? Because a lot of business owners I come across, they don't mind spending the money, but they need immediacy feedback. And
Right.
sometimes they don't see that the payday is a long play, that eventually you're going to sell, and we're positioning slowly your business to get the highest enterprise value. And I'm looking at enterprise value in a sense that we're going to sell. We're not doing an internal
Yeah.
transition to family or next gen in the company.
Right.
So how do you get them to buy into this ROI?
One of my favorite books, Frank. Did you ever read The Psychology of Money?
No, that
Morgan. Oh, it's so
I,
good. Morgan, first of all, not to plug one of your podcast competitors, but he's got a great podcast too.
it's all right.
Um, but
The more the merrier. There's a lot of
Morgan,
people here.
yeah, yeah, no, there's not nearly enough podcasts. Yours is
Thank you.
awesome, by the way. I really love what you're doing. Yeah, The Psychology of Money is one of my favorite financial books because it says that um, how much you plan, how much you save, how much you invest, how much you spend is all it's all different for different people. And there's really, you know, there are some right or wrong answers, but in general, it's a moving target based on what your
Yeah,
values
your
are.
relationship with money. I call it your baggage.
Yeah, exactly. So some people are all about, you know what, I want to die with zero. I want to have great experiences in my life, and I'm going to plan for that.
Okay.
Right? And that's a very different psychology than someone who grew up in the Depression or with some other scarcity mindset kind of
Hmm.
event. Those folks tend to be a lot more about, future looking saving, investing, really minimizing their spend. And there's no one right or wrong in those two
Right.
dichotomies, those two
Because
psychologies,
you
right?
got to live
It's
your
just,
life. It's your life. You get to choose.
yeah, right. And then keep going from
Okay.
there, right? So how that relates to your question is business owners also have their own
Hmm.
values. And so what I would say to a business owner who is looking at retirement is what is most important to you 3, 4, 5 years from now when you're planning to sell, and also what's most important to you post retirement.
Hmm.
Okay. But by which I mean, if your goal is to get the highest value for this asset that is your
Okay.
company, okay, um, and you are willing to do the math and figure out how each input translates into that output later, then do that.
Okay. Good
Do that.
approach.
Do that do that math because okay, so I was in-house general counsel for 8 years for a telecom company. And then I started my law firm, and there was another 2 years where I was their GC. And they were raising money um, to finance these giant growth strategies, and they were always looking at the exit,
Okay.
right? And they had a phenomenal exit. And um, I was fortunate to have been a beneficiary of that. I was lucky to be a shareholder in that company, but more importantly, I got to witness how these guys had a value and a strategy
Yeah.
match. So once they started raising money, they immediately started getting audited financial statements every single
Okay.
year. Okay. That's not
No.
cheap. Getting your CPAs to do audited financial statements um, every single year costs a bunch of
Right.
money. Right. And the bigger the company, the more revenue streams, the more expenses, more subsidiaries, affiliates, whatever, the higher that price
Right.
tag. So they were writing a high five-figure check to our CPA firm, maybe even a low six-figure check every
Wow.
single year. Okay.
Made you
But
guys a favorite client.
it was, I mean, their CPA firm was very
Yeah.
happy. Um, but the point is that paid off
Right.
massively for them. Okay. Because they started doing that a good 6, 7 years before the exit.
Okay.
Okay. And the buyers were lining up and they didn't have to do a whole lot of, um, they didn't have a lot of as much skepticism about the financial records as possible as they could have had. So that's just one little example of how your values match your goals and your
Okay.
strategies, right? Um, if and then one other thing I would say about that, right, is how you should think about how much you spend on all of your advisors, right? Not just your CPA, your lawyer, your wealth manager, your
Thank
estate
you.
planner, um, all of those things, right? Depending on how serious you are about getting the most value and the best payday at
Okay.
exit, that value translates to your strategy today. Um, and so I can keep
No, that's
going.
good.
Yeah, I'll eat up
No,
all your
no. So,
time if I.
so as we get close to the
Yeah.
end here, for someone that's barely started or hasn't started, what's the first action a business owner should take in the next 30 days? And I know you're a big believer in checklists and things like that. Does your firm have like
Yeah.
a initial checklist for a business owner to kind of go through and say, kind of do a self-assessment and then kind of reach back out to you to, for legal governance? But what
Yeah.
should they do in the next 30 days if they've done nothing or little to nothing in this area?
They should sit down with Frank and figure out what their needs are going to be post retirement
Okay.
and how likely their current situation and their current strategy is to meet those needs using a really smart wealth manager who has seen it all and who can check their blind spots and their assumptions about about the economy, about their portfolio, about what their needs are going to be, how their spending looks each year. So that's step
Okay.
one. Okay, and then from there, and Frank, don't forget. So I've got I've got my law firm, Gertsburg Licata. Our good friend, our mutual friend Lou Licata is my
Right.
partner there, and then I've got my exit firm and brokerage, Exit Path Partners, and so those are, and I, I say that not to put
Oh,
plugs
please
out
plug.
there,
You're
but
good at
to
what you do.
it's more to describe the
Mhm.
hats that I wear when I say what I'm about to say, which is after you talk to Frank, talk to um, a uh, um, an exit professional, right? That may be a broker, that may be an investment banker, that may be a valuation expert, that may be someone who does all three of those things. it may be a certified exit planning advisor, CEPA, but somebody who will advise you specifically on the strategy and the um,
Right.
path to your exit. Okay, so that's the second phone call you should make, and then the third should be to your business
Right.
lawyer, right? To start um, that journey that will uncover the blind spots, the minefields, the corporate formality issues, the environmental, whatever they are, and start not identifying, prioritizing, and
Okay.
eliminating
No,
those
great
risks.
advice. I know the thing I would add to that is the biggest challenge I think for most business owners is their business becomes their identity, their life. Not that they don't have family and things that they're doing on the outside, but their business sucks up a lot of their week. They need to have some sense of purpose. So I know one of the things we talk to our clients about is making sure that they can plan on doing things that create reward and purpose beyond the business because it makes it easier to walk away. Sometimes people stay on not just for the financial reasons, but from a psychology standpoint, I'm important every day I walk through the door. When I go to have a lunch and I run into my business associates, they know me as the business owner of ABC Company. So I think it's really critical that as advisors, and it can come from legal, it can come from us, but making sure that they understand they need to plan a life without the business. And the sooner they do that, it makes it a lot easier, I think, to walk away and to cut the cord.
So, National Geographic sent one of its reporters, journalists, a guy named Dan Buettner, around the world to find the communities in the world where they live the
Oh, the
longest,
blue zones.
the blue zones, right? And he found 5 cities on the planet where the average life expectancy was over 100. So think about that,
Mm,
right? So half of the people in these communities die when they are
right.
centenarians, when they're over 100 years old, okay? And so, he identified them, Loma Linda, California, Okinawa, Japan, Ikaria, Greece,
Hmm.
Sardinia, and, uh, there's a 5th one, and I can't remember what it is. I think it's in Nicoya, Costa Rica, is the 5th one. There might be a Scandinavian one in there. I'm screwing
No,
something up, I'm sure of it. But anyway, so National Geographic says, "Hey, great, Dan, go back out there and tell us what they all have in common." Because if we can put that algorithm together, well, that's the fountain of
right.
youth. We found 9 things in common, 9 things that all 5 communities had in common, and 2 of them are relevant to this discussion. One is in all 5 places, everyone in their old age have a strong sense of purpose,
Right.
right? And the way he defined it is if you asked anybody in Okinawa, Japan, who was 100 years old, what is your reason for getting out of bed in the morning? Like
Hmm.
that, every one of them will
Right.
have it. And it may be, oh, it's to raise my grandkids, or it's to finish this project, or to, whatever it is. But they will know it and they feel it emotionally. So that's one thing that all blue zones have in common. And the second is they actually don't retire. They don't even have some of them don't even have a word for
Right.
retirement. Why? They don't keep, banging it out as hard as they always were, but they slow it down and it doesn't stop. And why? It keeps your brain moving and it keeps your body moving,
Very well said.
right? So one thing that my team in Exit Path does is we work primarily with lawyers, okay, law firm owners, and law firm owners who retire. And this is kind of true for professionals, for all professional services, but definitely true for law firm owners. No one's going to come and buy your firm and give you a big check, um, where what they're really buying is goodwill and client relationships that might disappear the moment you
Right.
disappear, right? So what they tend to do is give them a lengthy earnout or a drip of payments over time to make sure that law firm owner remains
Hmm.
engaged. and maintains those relationships. And so our strategy isn't your sometimes it is, but usually it's not a, hey, here's how much money you can get for your law firm. More often than not, what we say to the owners of the law firms are, what do you do? What do you see yourself doing post retirement? And tell me what you do today that you love to do, that you're great at doing, and that makes your cash register
Right.
ring. Right. Those three things, if I know what those three things are, and then I know where you want to be post retirement, how you want to spend your time. A lot of lawyers want to keep mentoring young lawyers. A lot of lawyers want to keep golfing with their key
Yeah.
clients. What I say to them then is, let's marry up your post retirement, in quotes, future to your superpowers today, right? The things that deliver the most value to your clients, your employees, and to the buyer of your firm. And let's build a strategy that gets you from here, not to there, but through
Yeah. That's an
there.
important distinction.
Oh, yeah, exactly. And that, by the way, gets them way more money post retirement than just expecting some check up
Right.
front. Um, they will continue to receive origination payments for years to come. The buyer already has it baked into their business model to pay origination to their
Right.
employees and to referral sources. Become the referral source. Um, Usually by the time, if you're the owner of a professional services firm and you're, 65 or whatever, I bet you are amazing at business development. I bet you're amazing at key relationship management. Just keep
Yeah.
doing that, you know? And so anyway, I say all that because um, the path to the exit is often not just about, especially again for professional services owners, what's the check I can get, the day I retire, but rather, what is my lifestyle going to be? What do I want it to be? What is my purpose? How am I going to serve my purpose? And how can I um, actually keep making money
And doing the things you like to
and
do.
make,
Right.
yeah, exactly,
Alex, thank you for
exactly.
joining us. Alex Gertsburg, appreciate it. Gertsburg Licata,
Yeah,
thank you for being here. Hopefully, everyone gained a lot out of this. And if you haven't started, it's time to get started. Please look at exit and succession planning as a business strategy. If you like our podcast, please let your friends know. Follow us on returnonlife.com. And we're excited that you're participating. And again, Alex, continue to have a great year. Thank you for being on.
thanks,
Eh,
brother Frank. Always great talking to you. Thank you so much for having me on,
You're
man. It was
welcome.
fun.
Always fun with you. Take care.